In 1965, $100,000 invested in Berkshire Hathaway would be worth $5.5 billion today. In 2020, $100,000 poured into a hyped new energy stock shrunk to $40,000 in 6 months and never recovered. The same starting capital, the same act of investing. Why the astronomical difference? It's not luck. It's not IQ. The key lies in understanding Buffett's 8 time-tested iron rules. These aren't empty slogans. They're a practical guide extracted from over 50 years of shareholder letters and public speeches. Do you recognize these mistakes? Following the crowd into investments, panic selling at the first dip, cashing out tiny gains too quickly. These actions violate the core rules. Let's break them down, one by one, and learn how to use them to avoid 90% of common traps and make your money work for you. Rule 1. Protect your principal at all costs. This is the foundation of all investing. Buffett famously said, Rule number 1. Never lose money. Rule number 2. Never forget rule number 1. Real-life example. A neighbor invested his entire retirement fund into a sure-thing tech stock tipped by a friend. After an industry correction, he lost 40% of his capital in 6 months. Remember this math. A 40% loss requires a 67% gain just to break even. A 50% loss requires a 100% return. Buffett would rather make less profit than ever risk a large loss of principal. Rule 2. Stay within your circle of competence. Buffett compares investing to baseball. The best hitters don't swing at every pitch, only the ones in their sweet spot. For decades, he stuck to consumer, financial, and energy sectors, businesses he understands. During the 2000 dot-com bubble, everyone urged him to buy tech stocks. His reply, I don't understand how these companies make money. When the bubble burst, he was holding cash and ready to buy Coca-Cola at a discount. The takeaway, don't buy a stock just because a friend or expert recommends it. First, ask yourself, what product or service does this company sell? How does it actually make money? Who are its main competitors? Only invest once you can answer these clearly. Rule 3. Insist on a margin of safety. This is your crucial buying criterion. A margin of safety means buying $1 worth of value for 40 cents. When Buffett bought the Washington Post, its market cap was $80 million. His calculation showed its assets, newspapers, TV stations, printing presses, were worth $400 million. He was buying at an 80% discount. How to apply this? If a company earns $1 billion annually and is fairly valued at $10 billion, but the market prices it at $7 billion, that 30% gap is your margin of safety. Cheap isn't a low stock price. It's a price far below intrinsic value. Rule 4. Hold quality assets for the long term. Buffett's Coca-Cola investment has returned over 30x. He says, if you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. Contrast this with the average investor who sells a fund if it doesn't move in 3 months, often right before it rallies. Data shows that holding an index fund for 3+ years raises your probability of profit from 50% to 80%. 5+ years pushes the probability over 90%. Time is the friend of the wonderful business, the enemy of the mediocre. Rule 5. Make Mr. Market your servant, not your guide. Buffett personifies the market as Mr. Market, an emotional business partner who shows up daily with wildly fluctuating offers, sometimes euphoric, sometimes deeply depressed. The smart investor uses his moods instead of being led by them. During the 2008 crisis, Mr. Market offered fire sale prices. Buffett invested $20 billion in Goldman Sachs and General Electric. The average investor does the opposite. Panics and sells low, then FOMOs and buys high. Next time the market swings wildly, ask yourself, is Mr. Market having another tantrum? Rule 6. Practice concentrated investing, not blind diversification. The common advice is, don't put all your eggs in one basket. Buffett's version? Put all your eggs in one basket, and then watch that basket carefully. His top 5 holdings often make up over 70% of his portfolio. At one point, Coca-Cola was over 20%. Your attention is limited. It's better to deeply understand 5 to 10 companies than to superficially own dozens. If you have $100,000, instead of buying 10 funds, pick 2 to 3 with stable long-term records and trustworthy managers. Study them thoroughly. Rule 7. Focus on intrinsic value, not stock price fluctuations. Buffett says the stock market is a voting machine in the short run, driven by sentiment, and a weighing machine in the long run, driven by value. When he bought See's Candies, he cared about one thing: how many pounds of candy it could sell each year, and at what profit. The average investor obsesses over a 2% daily price move. We should be asking, will this company's profits grow this year? Is there high demand for its products? Is management competent? These factors determine long-term value. Rule 8. Be rational, conquer greed and fear. Buffett's most famous mantra: be fearful when others are greedy and greedy when others are fearful. In early 2020, when COVID crashed markets 30%, he was quietly buying. In 2021, during the speculative frenzy, he sat on $140 billion in cash. Meanwhile, in 2015, retail investors lined up to open accounts at the market peak. In the 2018 bear market trough, no one wanted to buy funds. Investing isn't about outsmarting others, but about mastering your own emotions. Your action plan. Pause now. Think about the last stock or fund you bought. Which rule did you break? Did you chase a hot trend outside your circle of competence? Did you sell in a panic after a small dip? Write these questions down. Review them before your next investment. Here's the hard truth. These 8 rules sound simple, but 90% of people fail to follow them. Human nature loves to follow the crowd, fear losses, and seek quick profits. Buffett became the Oracle of Omaha precisely because he fights these instincts. Starting today, do these 3 things. Write, protect your principal in your notes. Before every buy, ask, can I accept a 20% loss on this? Create a circle of competence list. Only invest in businesses whose models you can clearly explain. Next time the market crashes, don't panic sell. Ask, has this company's intrinsic value actually changed? The most overlooked rule is circle of competence. Many think they understand a business based on surface-level knowledge. Next time, we'll break down how to quickly build your own circle of competence. For now, save this guide. Remember, investing isn't a sprint, it's a marathon. Surviving in the market is more important than winning any single race.